Happy Monday, everybody. I hope you had a great weekend. Today is March 20, 2023, and this is your Monday market update. Once again, we're in the middle of some pretty active market times. I will say again, this is a noisy time, and our job is to pull the signal from the noise, and it is getting harder and harder to do so. These videos on Monday are really granular, and I love doing them, and I hope you enjoy seeing them as much as I enjoy making them. Next week, I'll come to you from a surprise location, so be ready. Last Friday, my planning video bled into some market news, so it's only fair to bleed into a little bit of planning into today's video. Over the years, you've probably heard me tell you that if we do your plan right, whether it be with mutual funds, ETFs, individual stocks, or bonds, it can often be pretty boring, sort of like watching paint dry. All we're doing is seeking to move day by day closer to your goals. Some weeks, months, and years, that seems to be going the wrong way, but focus a bit more on the longer term, and you'll see that most longer term time ranges are positive for market returns. It is the short term that's a bit tougher to gauge, and this should be no surprise to anyone. The 10-year time frame, 5-year time frame, those are easier to watch. The day-to-day, especially these days with the 1% to 2% swings as often as we've seen them in the past 3 years, they're harder to watch, harder to believe in, and harder to stay the course with. I asked a question on Friday's video, and I'll re-ask it today. Please let me hear from you. A week ago today, we celebrated, if you call it that, the 3-year anniversary of when the U.S. declared a national emergency due to COVID. I asked, what is different in your financial plan? Friday night, one of my friends told me that he is less confident in the future based on what's happened. This is so telling. And as I've spoken about recency bias before, as a behavioral finance idea, this is all about seeing things new or very recently and believing that they will be that way in the future. No one really knows, but if you go back through history, though we think this is all new, we've gone through so much. And inflation is not new, neither is slowing growth, geopolitical turmoil, bank crisis, and so much more. Think World War, nukes 90 miles off our coast, and for those not so recently biased people, 9/11 attacks. I mentioned this a few months ago, speaking about market downturns. Until now, we have bat 1,000 for recoveries. Yes, each downturn has been met with a recovery. I'm not in the camp, but we'll see that change. We need to keep to your plan. Yes, this Monday market update highlights what's going on today. Some opportunities may be coming along, and some cracks in the armor may be showing. But this is the noise. Remember the signal. Keep coming back on Friday as we focus on the goals and real things we can do to help us strive to continue to reach them. Okay, let's recap last week and preview this week. Monday, stocks gap lower. At the open, sentiment was fragile and very much on edge after the failure of Silicon Valley Bank and Signature Bank and the roiling of all the banks. We spoke about cash management again this past Friday, so if this is something you have not already addressed, please call me. President Biden has reiterated his confidence in the banking system and pledged more regulation. As I think I mentioned, problem with banking legislation is you can't regulate greed. It happens. Is that what's happened here? Not sure. Can the guard towers be manned once they're built? That's a different question. Aside from the banks, bonds were the big news. The largest drop in the 2-year Treasury yield since Black Monday in 1987. The 10-2s inversion went from last week negative 108 to negative 48. Recall that is a flight to buy bonds, pushing the price down and the price up and the yield down. Flight to quality. A week ago, the markets had a greater than 50% chance that the Fed would raise by 50 basis points, not 25. And by the beginning of this week, a 38% chance that there will be no hike at all. Terminal rate estimates went down from 5.625% to 4.625%. Would this really have that much of an influence? Seems that the market thinks so. Goldman, what seems to be the mouthpiece of the Fed lately, has changed their tunes. They are now saying the financial stability will not be well served by any move. So their new call, no move this coming week. After all that, it was a mixed market. The Dow was down 0.25%, the S&P was down 0.15%, and the NASDAQ was up just under 0.5%. CPI print Tuesday, and stocks gapped higher as the CPI was in line, and anything better than fear was welcome. So let's lock the door since the horses escaped, and the rating agency Moody made some cautious comments about banks. Geopolitics wanted in on the act. Russian warplanes knocked a U.S. drone out of the sky. Markets held on most of the day. With the help of huge market on close buy imbalance, stocks closed up, off a session high, but up. Dow was up over 1%, S&P up nearly 1.75%, and the NASDAQ up over 2%. Quick banking update as Hump Day approached. Goldman put out some more research on banking. That their idea that the banking crisis that small banks are dealing with. With small banks that are dealing with will help to keep the Fed from raising rates. Banks with less than $250 billion in assets, that's small banks by definition, they handle 50% of the commercial and industrial lending, 60% of the residential real estate lending, 80% of commercial real estate lending, and 45% of consumer lending. So when they have stress, that they're dealing with. Per Goldman, this is if the Fed, it's as if the Fed added 25 to 50 basis points to the Fed funds rate. This is also helpful in understanding why, when there's stress here, there's stress elsewhere. Banking News 2.0 on Wednesday brought back an old friend back into the news, Credit Suisse, a bank that's had hard times for a while anyway, got into the action. A lot of fear on how that bank will survive. I don't want to spoil it for you, but if you check out the news today, did you really think that one of the premier banks in the world bank capital would be allowed to fail? Don't think so. PPI was the big U.S. eco data, and it was actually pretty good for the bulls, much better than expected, not even just better than feared. Under the surface, as usual, you can note that a lot of that number came down to a 40% drop in egg prices, believe it or not. Markets opened heavy and spent most of the time in the red, ending the day mostly down. The Dow was down just under 1%, S&P down about 0.75%, and the NASDAQ just over the line into the green at 0.05% positive. As the world freaks out about the banks and is dusting off its 08-09 great financial crisis playbook, major difference. On the books of banks in 2008-2009 were mortgages that never should have been written and mostly worthless. Houses were underwater, financially speaking. Today, assets held at the banks are U.S. Treasuries. All the banks have to do is hold them, and they will be back at par. This is the liquidity issue, not a solvency issue, a big difference. Overnight and into Thursday, things were pretty quiet. In the newsroom, stocks opened a bit choppy. The Swiss came out with about $55 billion to Credit Suisse. ECB made their 50 basis point interest rate hike, and people started to rethink, will Powell blink or hold the line like the ECB, as if Powell and Lagarde are not on speed dial. As if this was not as if this was not in the cards, bank stocks led the markets higher, and stocks overall were up. Dow was up just under 1.25%, S&P up 1.75%, and NASDAQ led the charge, buying back into large cap growth, up about 2.5% on the day. Friday brought the sellers back out early. Banks were back for sale. SVB filed for Chapter 11. That's the bank we've been talking about, Silicon Valley Bank, or at least the parent company. Money is still backstopped by the government. University of Michigan inflation expectations dropped again. Make no mistake, you'll see it again today. Nothing steals the front page better than a good old-fashioned bank crisis. So most of the other news will be muted. Friday closed out on the downside. The Dow was down just under 1.25%. S&P down just over 1%, and the NASDAQ was down about 0.75%. For the week, the S&P stayed up in the green, up 1.5%. NASDAQ too, up 4.44%, and the Dow was the only loser, but only slightly. Dow was down less than 0.25%. Let's look at the coming week. Nothing major today, and tomorrow will bring some housing numbers. No doubt all eyes will be on Powell and the Fed, as we'll get the Fed decision on Wednesday about 2 p.m. Eastern. Set your clocks or not, but we'll see fireworks when the release is done, and then the encore and finale during the presser by Powell. Thursday will bring the all-important, or at least to some, the high-frequency data, jobless claims. We'll also get some more housing as well as some manufacturing data. We'll get more manufacturing data on Friday to close out the week. I do think most of this will be drowned out by bank and Fed news. The market's been resilient and been pricing a Fed pause, or at least nothing more than a 25 basis points. As I mentioned before, a week ago we were looking at high probability of 50 basis points hike. Now maybe none. Wrapping up, there is what we need to watch this week. Watch the smaller regional banks. We need them to stabilize. That will add a lot of good feeling to the market. Staying with banking, deposit insurance is all over the news. Of course, we want the government to backstop everything, right? Any parents see the similarity to accountability for the kids? Regardless, too big to fail is back in the conversation, and banks are asking for an increase in the limits of insurance and the time frame. Of course, the Fed decision is the key. I've already told you about this one. Finally, keep an eye out for that sneaky left hook. The Chinese president is visiting Putin. There are possible negative outcomes here, so let's hope it is a quiet visit. As we get into the week with all this, the S&P and the NASDAQ are still positive for the year, and the Dow is down about 3%. You have to respect the resiliency of the market. We have a lot of moving pieces to watch, and we will watch those for you. I'll be back on Monday with another market update, and please share this to people you think that may be interested. Please come back on Friday for some more planning ideas. Until then, have a great week and stay in touch.